here's the biggest thing is that you found $1,900 a month from my grandmother who lost her husband 2 years ago, and she had no idea of money that was leaking in her business, or not in her business, in her life, in her elderly age. And your team found that for us.
Strategy 2, reclassify your income. Reclassify your income. So if you don't have, there's so many ways to reclassify your income. At lunch, what I was talking about is because I have intellectual property, I can actually have a separate intellectual property company, and I can actually have some of my income be capital gain income. Capital gain for me is about half of what my ordinary income tax rate is, so every time I can get paid for intellectual property or the sale of that intellectual property, then all of a sudden that becomes a capital gain type of transaction, especially the way it's structured. There's more detail, but I'm just trying to get you to think. The other thing, taking ordinary income to capital gain, at lunch that we were talking about is, there was someone at lunch that was doing $7 million of revenue, so I said, hey, have you thought of setting up your own insurance company as a C Corp? You can put up to $1.2 million this year, $2.2 million next year, and then you can manage it like an insurance company, so it's conservative investing. But then if you ever have a risk that you need to pay for, that's tax-free. If you don't, you can pull that out and it's a capital gain. Once again, going from 40%, more like 20%. So that's one way to reclassify income. Let me give you the simplest way to reclassify income that will apply to everyone in the room to some degree, all right? So if you own a building, for example, charge yourself the highest possible rent because that's a 1099 more passive income than W-2. If you look at what you do on a daily basis, see what you would pay someone else to do the same thing, which should be less than what you're paying yourself, and only pay yourself that much or less in salary and take the rest of your income through distributions, because distributions don't get hit with self-employment tax. Self-employment tax is 15.3%. Even when that's maxed out, you still have Medicare and Medicaid at 3.2%. And when you're making more than $250,000, then it goes up to another 3.7% penalty for making an income. So if you can take it as a passive income instead of active, you avoid all that tax. So find every way you can do that, which might be the type of corporation you set up. You could be an S corporation and pay yourself what I call differentiating income, salary versus distributions. That would be an example of taking more passive income. Or once again, could you license your IP to your company? Because even if you don't do the big transaction I did, you're still going to get it where it's a 1099 type of structure versus a W-2, which will be lower taxes. So there's so many ways to reclassify income, and there's so many opportunities when you do that. So here's strategy number 3, or the third part of the framework, which is really on you first and foremost, but there's like 5 pieces to it, okay? The first thing is you gotta be proactive. If you're not actually meeting with your tax team every quarter, even if it's only for 10, 20 minutes, meeting with them before you send off your quarterlies, you're overpaying tax. If you're talking to your accountants right now about 2015's taxes, you overpaid. If you're not talking to your accounting team about 2017 and beyond right now, you're far too behind and you're gonna overpay on your taxes. So you wanna be proactive, which means if you don't like doing this stuff, hire a controller, hire someone that keeps this information for you so you could leverage and do the things that you're very best at. Then, if you found that you've been sloppy at all along the way, or you don't feel a high level of confidence in your accountant, or you just wanna do something that I would consider smart, every 3 years, have a different set of eyes look at your taxes, because you can go back 3 years and amend your returns. This just reminds me of my buddy. His name's Mike. He lives in Illinois. You know, talking to him, he joined our program way back in 2008, and he's like, this is awesome. I'm like, cool. Next thing you're gonna do is meet with the accountant. He goes, oh, no, I don't need to meet with the accountant. I have the very best accountant in the world. And I'm like, what's the name of your town? Do you guys have an airport? And he's like, oh yeah, we have a private airport. I'm like, exactly. Like, I don't even know where that place is. You don't have the best accountant in the world, I assure you. So what we did is we looked back for the last 3 years and we found he'd missed $100,000 in tax advantages. So he was able to amend and get that money back. Plus, he wasn't incorporated, even though he's doing $1 million plus of revenue. You want to incorporate just to protect your ass, but also because you can save on tax. So we did the whole differentiating income thing I told you about. That was $10,000 a year for him in tax savings. But then he owned a building. Anyone here own their own commercial building by chance? If you own a commercial building, you can actually bring in an engineer, do what's called the cost segregation study, and we're able to get him another $10,000 a year in tax advantages, because normally you have to wait 39 years to get tax advantages fully on a building, but if you have an engineer come in, you might be able to get it in 3 years, 5 years, 7 years. So $20,000 a year moving forward, $100,000 back. I was right, he was wrong. I let him know it because I'm that kind of friend. And but at least I gave him a big check in doing that. Now, let's fast forward to 2013. He gets audited. So the first thing, because we're friends, he's like, I hate you, you're an asshole, I'm going to jail. I know this couldn't have been, it's too good to be true. I'm like, dude, don't even go to the audit, it's not even gonna matter. So I made a bet with him. If we didn't save him money in the audit, then I would pay whatever he owed if we didn't save him money. But if I saved him money, then he had to take me to a Chicago Bears game because he's a big Bears fan, all expenses paid, and it had to be good tickets and a decent hotel and take me to a nice restaurant. Basically, he became my bitch, right? If I could save him money or not. So that's what we did. We went back and we were able to go with the auditors and just basically be really nice to them, give them every bit of information they wanted and all the documents, and they just signed off on everything. It was very short, but at the end we said, hey, by the way, Mike doesn't really write off his vehicle, I think very aggressive. What do you think? All of a sudden, because we were nice to him and they're not always used to being treated that way, and because we were professional, we were organized, we were calculated with every deduction we had a story behind all the expenses, we got $5,500 more in tax deductions for him through the audit. So, needless to say, I spent $2,000 of that for him very easily because he was worried. So I just share that story because amending is a big deal. I had 2 partners die in a plane crash back in 2006, and for 4 months, I did not make good financial decisions. I just didn't communicate with my team. It was chaotic. I tried to keep our whole business going. We had 42 employees. It was very personality-based at that time. So I actually got to go back in 2008 and amend my returns from 06, and I got $54,000 back, and I do this every day. So if you get above $1 million in revenue, it's time to start considering a tax attorney to work with the CPA. If you're not meeting quarterly with your tax team, you're probably overpaying on your tax. And every 3 years, get a second set of eyes, even if you love your accounting team, to come in and see if there's anything that's been missed, because your team might get in a rut and always look at it the same way, or they might just miss some of the things that are out there and available to you. And so we did that with a guy in Florida, and we found $120,000 of additional tax deductions. His accountant only took advantage of like 35,000 of them, but I was like, we were just the second opinion firm. I mean, I think that was well worth the hour that he spent, and it's too bad that his accountant wouldn't see the whole picture, but whatever, I mean, it's still a bunch of money in his pocket. And there's a lot of money for you just by saving tax. So now you know the framework. Don't just defer. And by the way, if you have a bunch of money in a retirement plan and you're upset about it, I'll give you my book, Killing Sacred Cows. So when you fill out that card, you can do one of 3 things on that card. Number 1, you can ask for what would the Rockefellers do. You can just put WWRD, and I'll give you a copy of that. You could put Killing Sacred Cows. Unfortunately, Killing Sacred Cows is out of print. I've been buying used copies. I just got the library book version of one yesterday that actually had the place to slide in the card, had the Dewey Decimal number on it, and the plastic coating. So I'll just send that in a PDF. And if you ever want to talk to someone on our team, just to find out if you're leaking money. Now, we're doing this because we want to build a relationship, and if we can find a bunch of money that's leaking for you, I know it'll be shocking that we can actually help you and that we could help you with those services and you could even hire us. But their goal is going to be just to ask you questions to find out if you're losing and leaking money. So you can put, for that, we call that a cash flow overview, just finding ways to boost your cash flow. So you could put CFO, you could put WWRD or KSC, or you could just write all 3, and we'll get you all 3. And by the way, just make sure it's legible and give us the easiest way to get a hold of you, because we're not going to chase you down. So if you want our help, just make sure we know the right number to call, that we don't get some gatekeeper or something like that, and we'll be happy to give you these gifts and kind of give you some more insight, because Killing Sacred Cows is kind of like a book that gives business owners permission to succeed. It gives you a language and framework that you'll already resonate and feel with deep down inside, but every other financial person that's tried to derail you or made you feel guilty has led you astray with. And so it helps you identify that misinformation so clearly that it's not like you have a bunch of strategy to implement after you do the book. You'll just be able to know how to move forward very clearly, so it's a permission to succeed type of book. What with the Rockefellers, on the other hand, shows you how to rig the financial game in your favor, because right now it's rigged against you. I mean, here's how simple it is to understand how rigged against you it is. If you're a bank, what do you want from people? This is where you guys answer. It's not rhetorical. Money, right. How often? Every minute. How long do you want to hold on to it for? And how much do you want to give someone back when they come to ask for a withdrawal? As little as possible, right? That's what we're faced with. Yet there's certain things that they do with their money that the Rockefellers figured out, and they started doing the same, like the Rockefellers started doing the things the banks were doing, so they boost their liquid savings up to 4% instead of 1%. They found ways to protect it from liability and bankruptcy. They didn't participate in the downside of the stock market, but when things went bad, they had a liquid amount of cash that they could utilize. Unfortunately, far too many business owners are so fully invested that they're illiquid. Not being liquid is one of the biggest travesties a business owner could face because, first of all, it gives you incentive to chase bad clients and bad profits. It's stressful. So I think having liquidity, the reason that most people don't have it, is what financial planner gets paid to get you a savings account? I told you to take one action, set up a wealth capture account. We don't make money if you do that. I just know that if people start doing that, businesses are going to succeed. And for me, I want 1 million business owners to get economic independence because if they do, they get exponential growth. And me as a customer, I get exponential value. And I'm cut from that same cloth because when I was 22 years old, I walked into something called the Rockefeller-style family office. And if you're worth $50 million or more, you got to go into this office and you got to sit around a table where you had accountants and attorneys and fiduciaries and cash flow people and insurance professionals all working on your behalf and saying, this is an A team. This is like the best of the best. And you know what? Their number one focus was to save on tax. And so I sat there and I'm like, I was 22, I came from a small town, wasn't worth $50 million. So at first I was fascinated, but that quickly turned to frustrated. Because I started to think, why do these guys get the best advice? And this is why they have sustainable wealth. They're not speculating and taking all their risk in the stock market. They built their money with their business and they found ways to preserve and protect it. And they have people looking out for them that can do real due diligence. In the world of finance, due diligence is like Sasquatch. You hear about it all the time, but no one's ever seen it, right? Because it's hard to do due diligence if the person is making a commission selling you something. At a family office like the Rockefellers designed, no one's selling anything other than they're charging a massive fee to protect your money, preserve it, and make sure it's perpetuated. So in what the Rockefellers do, I share that methodology so that you can now have that insight on how did they perpetuate wealth and actually have more along the way and stop, making certain financial mistakes. And then the one-on-one phone call, I'll just make sure if you're in this room, you talk to Garrett. Now, you're going to think it's Garrett. I almost didn't hire him because his name was too close to mine and that was confusing as hell. But this is a guy that was so awesome. Every time there's an Apple store close to us, and he kept working with a bunch of the people at our firm, and we'd go over there, and everyone was like, this guy's awesome. So we recruited him away. That's how you get A-teamers. You find out people who are employed, that love what they do, and you sell a better vision. And I just said, Steve Jobs is dead, and so is the heart of this company. Come to our company. And we convinced him. So anyway, Garrett is someone who just has a huge heart. He's so caring, and there is no judgment regardless of where you're at. Almost every business owner feels like they should be further along. Doesn't matter. The job for him, identify where you have leaks in the bucket so you know what to go out and plug. All right? All right, so I have just a couple minutes if there's any questions. Great. Then that means that we can end early and get the right people up here to keep giving you some insight. But I'll just say, make sure when you invest, forget about accumulation and focus on cash flow. Go for economic independence, plug the leaks first, continually expand your business, and that's gonna make a world of difference. And if some financial person comes and they're worried about taking your money because of the latest, greatest investment, say no, save the time, and put it back into your business, and you'll have exponential growth.
No questions? No questions for Garrett? We've got a few minutes. Let's head over to the microphone.
What's up, Garrett? My name's George.
What's up, George?
What would you say about student loans? Would you try to pay them off as fast as possible?
I would say this. We all have what's called cost of money. So cost of money is your highest net, best rate of return. So it has to be sustainable. But let's say that you could earn 5% and your student loans cost you 2%. Do you think you should pay them off? Probably not. But let's say they keep you up at night every night and it feels like you just can't live until those things are paid off. Then you might choose to pay them off. But here's the deal. Don't collapse method and objective. If your objective is to pay it off, don't just pay extra to that. Build a system where where you have control of your money, you have access to it, and you have liquidity so that you're not really overstretched and illiquid, and then you can pay them off in one fell swoop. But we have this guy on our team, his name's Tim Carden. And once I used to just tell people, oh, if you have student loans, there's not much you can do. And then I said that at an event, and he stood up on my team. He's like, actually, you can do this, this, and this, and here's how you can change the balance structure, and here's how you change the interest rate. So there's some pretty amazing things that you can actually do to get better rates or to get better structures with student loans. I would go there first. And then second, I would create a strategy, which if you dive into some of our stuff, look at our cash flow index. Because cash flow index will teach you, if you are gonna pay something off, you only focus on one loan at a time, never more than one, and which ones to actually strategically pay off that boost your credit score. Because once that credit score is boosted and you have the right cash flow reporting, you can negotiate better interest rates with every other loan you have. So it's really about making sure you still have access to money in the bigger picture. Okay, awesome. Cool. Are you actually asking a question? That's the real question.
I am not asking a question. No, I honestly just wanted to say something, Garrett, kind of a public thanks to you. I've said this over the phone, but Garrett, what he's talking about here, remember hearing it for the first time, and it just is like, wow, we have lots of leaks in our business. And Kim and I have been able to, over the last 12 months, he had no idea I was coming to the mic, but Kim and I have been able to plug all of those leaks and get about 80% of the way to economic independence with our passive income coming in every single month.
Don't expect that fast. That's pretty damn fast. We say 3 to 7 years. There's a few overachievers in the room like Pete.
But here's the other thing. Here's the biggest thing is that you found $1,900 a month from my grandmother who lost her husband 2 years ago, and she had no idea of money that was leaking in her business, or not in her business, in her life, in her elderly age. And your team found that for us. And the stuff he's talking about, like, take it seriously. Go find these leaks, because we've gotten a lot of money back from the IRS because of doing what you taught up here on the stage. So thanks for that, man.
Thanks,
I appreciate it.
Appreciate you.
Yeah.
Thank you.
Hi, Garrett.
Hey, how's it going, man?
My name is Scott.
Thanks for laughing at my jokes. I really appreciate that, Scott.
They were good, and your enthusiasm was really
My wife
awesome.
told me if I wanted to be a comedian, we would starve as a family, so just heads up on that.
You could tweak it a little.
Yeah.
You'd work it out, I think. I recently set up a family and a business trust.
Okay, great.
As well a foundation. So I'm going to start incorporating 1041s. Does your group get into that part as well, those vehicles? And as well, what's your opinion on the whole life dividend paying policies?
So in What Would the Rockefellers Do, I have quite a bit of opinion on it. I feel like most people don't structure them properly, but if structured properly with the right type of company, it could be a good storage vehicle. I don't see it as like the ultimate only place to put your money, but as a place to store it, to boost your savings return, and to access money along the way and have some tax favor. You really have to make sure it's not completely commissionable policies. It's high cash type policies that pay up early so that you have a lot of flexibility in them. But when you get that book, you'll get a good lesson on how to handle those.
Fantastic. Yeah, I had put in money. I changed my IRA into a Roth IRA, and my accountant's all high on how the great savings are. And I'm like, but I'm also looking at this other policy. I'm like, holy shit, I can be saving so much more money and utilizing my own ideas on investing and savings and not worrying about what that tax has later in life. But excellent. Thank you, Garrett.
Great. Thank you.
Okay, I don't have a question for you. But
I was going to ask if you had a question.
I don't really have a question for you, but I have to tell you, since I haven't seen you. So you did this webinar for my private inner circle group, and she just reported yesterday that just from the webinar that you did, she saved $25,000 just from this content from the webinar.
So do something with what I just talked about.
Yeah, right?
Yeah,
and then dive in deeper, because she's like, I'm going all in. Anyway, thank you.
Well, thank you. I really appreciate it.
All right. Thank you so much.